All right, welcome everyone. Thanks, David, for having me. We've got a lot of good stuff to go over in the next 45, 50 minutes or so. And my name's Tim Racette, and we'll be talking about using the NYSE tick to pinpoint entries and help kind of fine-tune your entries and exits in the markets. So my primary use for the NYSE tick is with day trading. It doesn't really matter necessarily what um, market you're trading per se, but it definitely is a huge benefit when it comes to day trading. So we'll get into a lot of nitty-gritty stuff as well as kind of some bigger picture things that you can kind of help incorporate into your trading to help your trading and improve and kind of pinpoint and fine tune things along the way. So we're going to talk about a couple of different things today. We're going to go into how to kind of identify those low risk entry points. So regardless of your trading strategy or what you're using for entering a trade, you can kind of pair that with the NYSE tick, and we'll talk about how you can do that and some best practices to use with the NYSE tick. And we'll also talk about how you can kind of, as the cliche or saying goes, stay in your winning trades longer and maximize the trades that you get in. So rather than trying to just increase the frequency of my trades, I prefer to go for quality over quantity and maximize the reward potential. That way, every time I put on a new trade, I have max risk on the table. Whereas if I'm in an existing trade and I'm managing the trade, I'm going to be tightening my stop as I go, managing the trade based on, the way the market is reacting, and I can cut down my risk along the way. And there's some things you can do to help maximize the reward. And then we'll talk about, what some of the pro traders are doing that really help keep us in the game for the long term. And as most of you know, trading has a lot of ups and downs. And so you want to be able to not just maximize gains, but also limit drawdowns because you could have really high highs. And if you have equal lows, then you're just right back where you started. So a little bit about me before we dive into all the nuts and bolts. Like I said, my name is Tim Racette, and I blog over at eminimind.com. I've been trading since about 2006, 2005, 2006. I'm originally from the Chicagoland area, and I got my start actually with swing trading. And my primary focus now is day trading, and even more specific than that, day trading the ES, the E-mini S&P futures. And so I've had the opportunity, the privilege to, uh, be mentored by a lot of good traders. Growing up in the Chicagoland area, you have a lot of access to the markets, to Chicago Board of Trade, Mercantile Exchange. Thinkorswim was kind of coming of age at that time, so got to kind of get to know Tom Sosnoff and Dom Kaufman and a lot of those guys who were the founding fathers of Thinkorswim and a lot of other great traders and things like that down in Chicago. So swing trading and day trading are kind of my main two focuses. They actually make a nice pairing because, swing trading, you're looking at daily charts, and day trading, you're looking at intraday charts. So there's not a lot of overlap. I'll do my swing trading analysis, homework after hours, looking at daily bars. And so there's not a lot for me to do intraday on the swing trading side. So they make a nice little pairing. I've had the pleasure of speaking at a number of the Traders Expos and these synergy events and money show and things like that. And then outside of trading, when I'm not in front of my screen, I spend a lot of time mountain biking, exploring the outdoors, just getting outside, getting away from the trading screen. And that really helps, keep my focus when I'm in front of the screen trading, then I can be super focused and then, get away from the screen. When I first started, I spent a lot of time, I guess I should say when I first started day trading, I spent a lot of time in front of the screen, and that definitely is necessary to a point. But if you can kind of figure out when your strategy is the most effective, or you could ask it another way and say, when are the markets most active in providing the most opportunities, which for most day traders, that's going to be the NYSE open. Then just focusing on that time frame and ignoring everything else is a really good way to go. So, like I said, growing up in the Chicago area, I've had a lot of good trading mentors and things like that. I then attended Arizona State University out in Tempe, and now I live in Scottsdale, Arizona. So let's dive into what is the NYSE tick, and we're going to specifically be talking about the base NYSE tick, not the cumulative tick or some variations of the NYSE tick. So let's just dive into it, and then I'll keep my eye on the chat window. If you do have questions, feel free to drop them in there. I'll try to answer them as we go. That way you're not waiting until the end. So the NYSE tick is, as kind of the name implies, it's derived from the NYSE index. And so it's going to take all of the stocks on the New York Stock Exchange, and what the number gives you, the NYSE tick reading or NYSE tick indicator, if you will, it gives you this relationship of stocks that are ticking up versus ticking down. So you get a net number. And if that number is, let's say, so the number itself is going to be somewhere between 1,500 and minus 1,500. So if you have roughly 2,500 stocks on the New York Stock Exchange, you could have some stocks that just moved up in the last print, some that moved down in the last print, and then some that were unchanged. And so a plus 1,500, minus 1,500, those would be the far end of the extremes that you would see when you're looking at the NYSE tick chart. And they're all based on, the NYSE tick is pulling data based on the very last price. So what was the market doing kind of the last second or the last print? And that's why it's a very useful intraday tool, because it's giving you very, real time, down to the second readings and prints. And so it's not lagging, and it's not kind of pulling information and then using past data to kind of give you a trend line or some kind of average of the past. So the NYSE tick is basically the net number of stocks that ticked up versus ticked down. And like I said, it's extremely useful for day trading. So this is what the NYSE tick, basic NYSE tick chart will look like. And there's a couple different ways you can set it up. So I like to use a 1-minute chart. And the reason for that, which we'll get to in a little bit, is we're mostly concerned with the extreme highs and lows, or the highs and lows that stand out, the relative highs and lows. So, a 0 on the NYSE tick is kind of baseline, dead flat. But on a day where we are, let's say a day where we don't gap up and we don't gap down, we just kind of like today, we opened right at the close of yesterday, we kind of moved sideways a little bit. There we filled the gap, in the first minute. You're going to get NYSE tick readings kind of inside of 400. So going back to, what is that number made up of? If you've got 2,500 stocks, we'll do some quick math here. If you have 1,000 stocks that just moved up and 500 stocks that just moved down, and another 1,000 stocks that didn't move at all, again, this is the last print, or we'll say the last second, if you will, then you're going to get a reading of plus 500, 1,000 up, 500 down, the other 1,000 are unchanged, total of 2,500 stocks, and the print is plus 500. And so the idea behind the NYSE tick is that if all these stocks are moving in one direction, or, a lot of stocks, that's where we get the idea of the extremes are where we're putting our emphasis and what's most important. If we have a reading of 100, there's a whole lot of ways we could get to that number. We could have 2,400 stocks moving up. And let's say 2,300 stocks moving up. Let me redo that here. Quick math here. Okay, so if we get to 0, let's just say we have 1,000 stocks moving up, 900 moving down, and the rest are unchanged. That's going to give you a plus 100 reading. You could also have 500 stocks moving up, 400 down, and the rest unchanged. So you can see there's a lot of variation with the number of stocks that are moving up versus down. But as you get to the extremes, closer to plus and minus 1,000, now we know if you get a reading of minus 1,000 on the NYSE tick, we have at least 1,000 stocks moving down if the rest of the stocks in the New York Stock Exchange were all unchanged on the last print. So the extremes are where we want to put our focus. And the best thing to do if the concept of the NYSE tick seems intriguing is to just put the chart up on your trading screen. Don't have to make it huge. 1 minute bar chart is how I have it set up. I have a 1 period moving average. You don't have to have that on there. Just kind of helps give me a general smoother trend, if you will. But a 1 minute bar chart is super simple, and that will help you be able to see the extremes as they pop up. If you do use like a 5 or a 15-minute chart, it's a little bit hard to tell, well, when did that high print occur within the 5-minute or 15-minute bar? So I would say in general, if we kind of back up and think about the different pieces of trading, you want to focus in on one market, one time frame, and one strategy. And strategy can be a little bit of a broad term, but really we're interested in entry point and exit, how you're going to get into the trade, and then how you're going to manage the trade. And ways to get in the trade, you may have things like moving averages or a host of indicators. You may not use any indicators and just look at price action. You may look at the shapes of candles, and you may look at the NYSE tick. And so the way that the NYSE tick helps us get into trades is we want to be getting long when the NYSE tick is in a low print. So a low NYSE tick reading should correspond with a long entry, and a high NYSE tick reading should correspond with a short entry. Because if all these stocks are moving in one direction, there's a very strong chance, we're not going to stay moving in that direction indefinitely. And when you get these extreme plus 1,000, minus 1,000 tick readings, you tend to snap back. And that snap, you get a high tick and you go short. That snap helps you get into the trade and get the trade moving away from your entry in the direction you want it to go down quickly and gets you some wiggle room. So you can get into a trade on the ES with a 2-point stop and using the NYSE tick to short in a relatively high tick or buy in a relatively low tick. You can have a very tight 2-point stop and then immediately be up a point, point and a half, 2 points, and then start to manage the trade from there. So, like I said, we're looking for extremes in the NYSE tick, and a plus or minus 1,000 is an extreme. A reading of 0, not interested. A reading of plus 400, minus 400, again, not really interested. It's a pretty narrow reading, very flat, close to the 0 line. As we start to get up to 600, 700, 800, okay, now I'm more interested. And if we go back to the chart real quick, one thing that applies not just to the NYSE tick, but everything in trading is the stock market theory of relativity, if you will. And we are interested in where is this current print as it relates to the prior print? Or you could say, where is this current low tick relative to the prior low tick? If you're looking at a chart, you might say, where is this current swing low? Where are we at relative to the last swing low? And that's how you can start to paint the picture of if you're making higher highs and higher lows, you have an uptrend, lower highs, lower lows, have a downtrend. All the basics and the fundamentals of trading, stem from this kind of theory of relativity. So as we just look at this general NYSE tick chart here, we can kind of see the 0 line is marked in kind of that grayish horizontal line, and most of the prints on this chart are below the 0 line. So if we get a move up to like the high print in this chart is right about 500. Well, that's not extremely high, but for the session here, this is about an hour and a half worth of time. For the morning session, since most of the NYSE tick prints have been underneath the 0 line, then a reading above 0 into that plus 400, plus 500 is starting to be a bit of an outlier. And so you could use that word outlier in place of extremes, just to help kind of remind yourself that we're looking for things that stand out and things that are relatively high based on the prints that we see, or relatively low based on the prints that we see. And so keeping that in mind and going back to the basic rule of we want to be shorting in a relatively high tick and getting long in a relatively low tick. And, the NYSE tick is, out of all the things that you could look at, especially if you're trading the futures market, which for most people is going to be, we're talking a stop, just a couple of ticks above or below a certain point. An entry, is one tick above or below a certain point. We're getting very, very technical. Whereas if you were trading options or even stocks, you might have a little more wiggle room in your entry. You'll say, I'd like to get long, within 20 cents of this area. With options, there's certainly a lot more variability as the option relates to the underlying stock. So for that reason, the NYSE tick is definitely heavily used with day trading, and especially day trading the ES. A lot of the bigger players tend to gravitate and trade the ES. The little bit larger tick value, so $12.50 per tick, helps slow down the trade ladder a little bit. If you look at like the YM or the NQ, it can be enticing to have a $5 tick incremental value, but man, do those trade ladders, get moving fast at times. And so a lot of, most of the seasoned and pro traders and things like that are trading the ES. If you're trading the NASDAQ, the NQ, there is a NASDAQ tick. And the charts that I have, the screenshots are all using Thinkorswim charts, but most platforms have tick data, and you can try starting with $TICK and see if that pulls it up. But some variation of that with the NASDAQ tick in Thinkorswim, you just put a /Q, and that gives you the NASDAQ tick. So we mentioned the extremes, plus or minus 1,000. It's not sustainable for all these stocks to be moving in one direction that strongly. And so then you get these kind of snapbacks or retracements or pullbacks or whatever you want to call them. On a range day, we want to fade these extremes. So selling high ticks and buying low ticks. On a trending day, what ends up happening is you make a high tick and you make a small pullback and then you move higher. And so there's a couple of tricks to identifying, the type of day early on. And one of those is, just kind of as a sidebar, is using the first 30-minute range. And if we stay within the first 30-minute range, so 9:30 Eastern is market open. After we get to 10 o'clock Eastern time, mark the high and low for that first 30 minutes. Boom. If we stay within that range, well, by definition, we're range bound. If we break out of that range and stay out of that range, now we have a good chance of going into a trend day. And so if we are trending, we want to be, let me rephrase this. If we're trending, we don't want to be going counter trend. On a range day where we're moving sideways, come up to the top of the range, fall to the bottom of the range, come back up to the top of the range, back down to the bottom. You kind of repeat that over and over as you move sideways. And it might not be all day that you're in a range. It might be a period of 45 minutes, an hour where you're moving sideways and selling high ticks and buying low ticks. When you get into a trending period, and again, it could be half hour, it could be a couple hours of the day. If we're in a downtrend, we want to be looking to trade with the trend and sell those relative high ticks. So the idea of selling high ticks, buying low ticks is still the same. We just want to forego the counter trend. It's not that counter trend trades can't work in a trending environment. It's just more risky that the market is going to continue in that trend and could just steamroll right through you. That's a good question. There is actually an S&P tick, but since the way the S&P is made up, you got 500 stocks, whereas the NYSE has 2,500 stocks. That bigger basket actually gives you a better, kind of more comprehensive reading of what the broader market is doing. And so for that reason, the NYSE tick is a little bit more, I don't know if accurate is the right word, but it's a little bit more, since it includes more, it gives you, I suppose accurate is the right word, a more accurate picture of what's going on in the broader market and not just the S&P. So on trending days, you want to trade with trend, and that involves kind of passing on those counter trend moves. And so anything inside of 400 is going to be pretty much chop. You can kind of ignore them. And if you start to it's like almost if there was a way you could just black out the middle of the NYSE tick chart and not see anything within that plus or minus 400 and only see the extremes, that'd be, I suppose, pretty helpful. But yeah, you can kind of ignore the middle of the range and just start paying attention when we get, outside of that 400 range. You don't have to use the 1 period moving average. That's just optional. So when we get a high NYSE tick reading, that lines up exactly at the same time as we get the high price, well, that could be the high of the day. And that's one of the reasons the NYSE tick is so powerful, especially when the market is moving sideways or range bound. You can catch these reversals. It's not that we're trying to pick tops and bottoms, but you can catch those reversals, even if it's not the high for the entire day. You could have a high ticket highs, and it's the high for that hour or maybe the morning session. And so it's a really good way to kind of help give some robustness to your entries and limit some of that risk. So a low tick at low price is just the same thing in the other direction, could be the low of the day. And if we do get high ticks without a high price, then it can be an early sign that we're going into a trend day. So the way that I look at look for early trend signs is if we get a lot of times what happens, you'll get a high ticket highs. And then you only go 30 seconds or a minute, and then boom, you punch through to a new high. And you do that 2 times, 3 times, and that, it could be in 5 or 10 minutes, and all of a sudden you're off to the races. And so if you get a high ticket highs and the market is just hasn't really established much of a trend, it's early in the day, maybe you're only 15 minutes into the day, keep an eye out for getting a high ticket highs and then making a new high very quickly. I typically don't trade in the first 15 minutes. It's going to take the NYSE tick a little bit of time. Any chart is going to take some time to develop highs and lows. And so if you get an extreme gap on the day, you could open up with some, let's say we gap down really big. You could open up with some minus 1,000 ticks, and then we kind of settle in or work our way back up towards the zero line. And so on the flip side, a day like today, we open up pretty flat. The NYSE ticks are moving not much. And so it can take a little bit to get some of those extreme readings. So it also helps, be a little more patient at the open and not just rush into a trade, take a stop out and then be frustrated for the rest of the day. So looking for those high ticks at highs and low ticks at lows are really important. If you get that high ticket high, could be the high of the day. Low ticket lows could be the low of the day. So what that looks like on the chart is we get a high tick on the NYSE tick chart, then a high price on your chart at the exact same time. And there's different ways you can, I guess, play this. You can look at selling at that moment. You can look at a specific candle, like an inverted hammer, that corresponds with the same time you get a high tick, or a hammer the same time you get a low tick. Another entry that I'll use is a halfway back and just drawing the first retracement on a small time frame after you get a high ticket highs. So basically, if you get a high ticket highs, you want to be looking for a short entry, and there's 1,000,001 different ways to get into the market. So just giving it 10, 15, 20 seconds and putting a limit order out there is one way with your stop above highs. Waiting for a candle to close and selling below the low of that 1 minute candle is another way. And then just using a Fibonacci tool or a halfway back drawing to get into a pullback or retracement is another way. Once you're in the trade, the two methods that I use to manage my trades, even if you don't end up using the NYSE tick, The two methods that I use are to either trail swings. So if you're getting short, you would just move your stop above each swing high. So you kind of drag it down to the swing high. Market moves lower, rallies a little bit, sells off again. You just bring it down to the next swing high. Or a more aggressive approach is to trail each candle. And if you're on a 1 minute chart, that's a pretty small time frame. So you're going to be moving your stop very quickly, reducing your risk very quickly. If you go down to something like, not to get confusing, but a 512 tick chart, which is good for trading the ES, you're going to have much faster candles forming, and you'll be moving your stop very, very quickly. So you can get into these trades, reduce your risk very quickly, and then be in profitable territory, and then just be trailing your stop as long as the market's going in your direction. So a trending day, so this would be kind of more of an example of a range-bound day, just because we have a pretty balanced above and below the zero line on that NYSE tick chart. Whereas if we are in a trending day, you're going to see the ticks kind of weighted or biased one way or the other. So this would be an example of a downtrend and a downtrending day. And most of the tick readings are down below the zero line. So that means when we rally, a print up to the zero line is going to be relatively high for that day. And that's where I say, okay, the plus or minus 400 is kind of the baseline of not really interested in those prints. But if all the price action is happening, down in the minus 600, minus 800, minus 1,000 on the day, and then we move back up to plus 200 or plus 400, what would normally be not a very extreme or standout number is going to be worth paying attention to on those types of days. And so you can look at kind of the general trend of the NYSE tick, and a lot of times you'll have a downtrend in the NYSE tick and a downtrend in the market, but also just kind of paying attention to where are the relative highs and relative lows on the day. So a couple other examples. When you get these low NYSE tick readings, so the lowest tick for the day, looking for a long entry, and you could be either looking at a pullback to a trend line. I like to use limit orders. In certain cases, I'll use buy stops and sell stops if I'm going long, above a candle or below a candle. But either way, whenever I'm about to enter a trade, I always glance over at the NYSE tick to make sure that if I'm about to go long, I'm in a relatively low tick. If I'm about to go short, I'm in a relatively high tick. This chart setup that I have, I can share kind of this workspace layout. I'll put a link later. If you do have Thinkorswim, you can go to that link and then just copy this NYSE tick box and kind of import it into your Thinkorswim workspace. And then it saves you a couple steps as far as getting it set up. But you could be on TradeStation or Ninja, it doesn't really matter. Most all platforms have NYSE tick data. So the next thing that I want to kind of talk about that kind of ties in with the NYSE tick, you probably see these little kind of boxes in the upper left hand of the chart, is going to be the breadth and the AD line. And so those two indicators, if you will, kind of make up what we call the market internals. So kind of what's going on underneath the hood internally with the market. So the NYSE tick, the market breadth, and the advanced decline line. And those can help really give you a good picture of what's going on with the market. And this is another way to depict the NYSE tick using a 15-minute chart and just the candlesticks. I don't love using that for trade execution just because it's a little harder to see when the print actually occurred if you have a 15-minute candle. But if you're going to be looking at 15-minute charts for execution, then the NYSE tick chart at that same time frame can be useful. So the market breadth, or the breadth ratio, is a relationship of volume flowing in up versus down stocks. And so again, if we go back to 1-to-1, we kind of think of it like a tug of war. If we have the same amount of volume flowing into the stocks that are moving up versus moving down, then each side of the tug of war is going to be the same strength and you're going to go nowhere. So a reading of 3-to-1 or -3-to-1 is going to be kind of start giving you some strength. And now that one side of the rope is going to be able to tug it quite a bit compared to the other side. 1-to-1 is going to be chop. And so that up volume versus down volume, that's the relationship that the market breadth gives us. The advanced decline line, that is going to be the relationship of kind of how many stocks on net are moving up versus down. So a 600 is starting to get towards some strength, plus or minus 600. If we're, again, inside 400, close to zero, that's going to be pretty choppy. So if we see a 1-to-1 breadth and a plus 300 AD line, that's going to indicate there's not a very good chance that we're going to start ripping and trending super strongly. So the stocks that are going up minus the stocks that are going down is what gives you the advanced decline line. So going back to that chart again, if you have this in this specific instance, just about a 3-to-1 breadth reading and plus 1,000 on the advanced decline line, that's a fairly strong AD line reading, and 2.8 is getting to the point where we're pretty strong. We're likely going to be trending. And at that moment in time, this bottom right chart is the ES chart. And this was I snapped this from a couple days ago. We were trending at that moment in time. So those numbers are going to change throughout the day. It's helpful to note what they are at the open. And again, the theory of relativity, going back to where did we come from at the open? If we opened at 5-to-1 and now we're down at 2-to-1, well, we've become weaker over the course of, let's say, a half hour. And what has the market done? If the market's pulled back, that would make sense. If the market's continued to rally, there's a good chance that we're about to pull back. If under the hood, there's less volume going into those up stocks. If we opened at plus 1,000 on the AD line, and then we, 20 minutes in, we're trading at 1,500, well, there's a good chance we should be going up. And if the market's still flat, then we're likely to break out in the near term. So looking at the relationship between the breadth, the AD line, the NYSE tick, they're all very, very helpful. They can take some time to get comfortable with, but the best way to do that is to make notes each day, at the open, look at the breadth, the AD line reading, and then what I used to do, I had this Excel spreadsheet with 15-minute increments, and I would put down the breadth and the AD line every 15 minutes, and I could kind of track it throughout the morning. You can also set it up in kind of a chart view and watch the trend change versus just having the boxes. But you just kind of get in the habit of looking up at those numbers throughout the morning, and then it becomes kind of second nature to kind of be checking in and seeing what's going on under the hood, kind of like checking your dashboard on the car. In Thinkorswim, you can set up alerts like bell sound alerts for extreme tick readings. So like plus or minus 1,000, I have a ding that goes off. I find that really helpful. You can probably set that up on Ninja and other platforms too. You can also put some, like I have this dashed line at the plus or minus 1,000 level. That helps it be a little bit more prominent. And then with the zero line marked as well, you can kind of see, okay, are we spending more time above or below that zero line? So one kind of final piece that I always like to end on is that there's really no substitute for the screen time. Um, you can learn a lot of things and study and practice, but the time in front of the screen when the market is open, it's almost like time on the court or time on the ice or time doing the thing. Like you need to be trading in real time in front of the markets. And so at first, it might mean spending more time in front of the screen, not just the open, but if you can be consistent, it's a lot better to trade 5 days a week for 2 hours every day at the open than it would be to trade one day for 8 hours, because you're going to get a lot of different scenarios that's set up day after day in that same time window. Then you can start to compare, oh, let's look at the trend days from last week and compare them to the trend days from this week. Let's look at the last 20 range bound days and try to compare, similarities and how do they differ from trend days. So short bits of consistency will add up, and those that kind of repetitive yet consistent day after day, looking at one market, one time frame, one strategy is what's going to kind of help give you that consistency over time, and then really build the longevity and not just be bouncing around from one strategy to the next for a couple of months and then just give up altogether. So work smart, be patient, and stay disciplined. And if you go to emoneymind.com/NYSE-tick, I've got that tick chart code for Thinkorswim and a couple of other things you can use for the NYSE tick and how you can apply it to your trading over there. So thanks everyone for tuning in. I know there's a lot of kind of technical details around the NYSE tick, but you'll be able to watch the recording again, and I've got my email on the screen there as well. You can always shoot me an email if you think of something afterwards or have any questions or want me to look at a chart or something like that. Happy to help, and I want to thank David for hosting these events. A lot of great presenters and great information. So thanks everyone, and have a great rest of your evening.